Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an exciting episode with a very special guest, Mr. Mike Nissley from Colliers Manufactured Housing and RV Group. Welcome to the show, Mike.
Thank you very much, Andrew. I appreciate the time spending with me.
Yeah. To dive in and give a little background on Mike, he's the founding member of the Manufactured Housing and RV Group at Colliers, where he serves as vice chair and national director with over $100 billion in commercial real estate transactions under his belt. That's billion with a B. Mike's experience spans sales, consulting, valuation, financing, and appraisals for major names like Parkbridge, Keystone, Carlyle, Sun Communities, RHP, ELS, Inspire, Yes Communities, and I could keep going. There's more on this list here, but Mike is definitely a veteran in the space. Most recently, Mike closed a 24-property Canadian manufactured housing community portfolio that sold at nearly $200 million, which was the second largest Canadian manufactured home/RV resort portfolio acquisition for a large Canadian pension fund. And also in 2022 and in 2023, Mike closed $114 million and $86 million mobile home community portfolio in Central Florida. So Mike, excited to dive in and kind of get your perspective. Would you mind maybe just starting out by telling our listeners a little about how you got started in manufactured housing?
Yes, yeah. It's interesting. My family got into the business in the early 80s, and they were buying small mobile home parks and out of the Tampa Bay, Florida area. And so I was in school at the time. But my grandfather used to drive me through the parks and tell me what they were doing. He was more of the money, but he wasn't the operator, but he was proud of his venture. He was a retired Wall Street investment banker. So he would drive me through. And then after I graduated from college, they had accumulated a, nice little portfolio. And my grandfather had died, fairly, I can't remember the exact year, but he had died. And then my uncle had taken over the family business. And then I think it was 1999 or 98, my uncle died. And then my grandmother tapped me on the shoulder and said, I need your help. And so I was working for one of those .com companies in Miami. And so I just dropped everything and went into the business and, had to learn everything because I wasn't, I didn't know anything. So I met some, key people at the beginning. People like names that you've heard in the business, like the Newby family, the Newby management.
Yep.
They were one of my first contacts, George Allen, and some of the other kind of founders of the industry. And so they introduced me to other good people that got me educated and so that was the beginning of all of it. But I had to learn about my family's portfolio. We had a partner, and so I had to learn about the operations and financing and everything and acquisitions and personnel and just, all the, park-owned units and rehab and all that stuff. And so, the family member that was the owners was my grandmother, and she was the boss but she was, passive. And so I was sort of representing the family's interest. And so it was just a great start and a great opportunity to learn, pretty early on. I decided that it wasn't going to work for various reasons. And so I ended up, there's friends of mine in the business that were like, hey, why don't you just do what you're doing and just, be a broker and come over to our firm. And so someone at Grubb & Ellis recruited me, and I came to Grubb & Ellis, started their group, and everybody laughed at what I did and said, ha, ha, mobile home parks. And so I got all the, typical kind of teasing about the asset class because everybody else was doing all kinds of fancy stuff where they could dress up, and I was doing the other stuff. And so maybe 18 months later, still made nothing, finally started closing deals like shortly after. my wife was, along the way was like, are we making a good move here? We left a for sure thing for this. And so, eventually deals started closing and things started working. And then year 3, 4, 5, I became like the top producer at Grubb and Ellis in Florida for all of those 3 years. And then maybe 1 or 2 of the years I was in the top 50 of the whole company. Was at the time was one of the biggest companies, public companies. And so that was fun. And it happened fairly quickly. And I was married with 3 or 4 kids at the time. So I was a little bit, I wasn't like a 21-year-old that started. I was probably 30 something. And so I had a lot of responsibility, but it felt good to have that success. And, met a lot of people in the industry in the early days, some of the people that are like legends now. And so saw them when they were starting off and humble. And so it was a great experience. And then, so towards the end of my years at Grubb and Ellis, I started looking around because people started calling me and they heard about what I was doing. And so some of the big firms were all interested because none of them were in. The only other firm that was in it was Millichap. And Millichap
You're
was
saying,
like,
just to pause there, so they didn't have an
yeah,
MH division, like a manufactured housing division
none
at
of them.
all.
Yeah.
They were
None of them. Yeah.
office, they were more,
Yeah.
multifamily, more traditional.
Yeah. Yeah. So, and then it was just all the little independent brokers. So it was sort of the beginning of institutional brokerage. So I made the jump from Grubb and Ellis to CBRE, which is the biggest, most well-known firm in the world. And so I said, wow, this is going to be exciting. I talked to people and I had offers from other groups that were, good offers. And I was like, wow, this is pretty cool. Sign-on bonus, all kinds of stuff. And so, but I just thought CBRE gave me a big platform to leverage. And so I made the jump to CBRE, started the group there, hired people, got a nice large team around the country and had a lot of success. My expectations were I want to see what the biggest deals are and the most sophisticated firm you know and so I think it fulfilled all those goals and objectives. And then after about 10 years or so there, I'd been trying to recruit Bruce Nell, who works for Colliers. He's the top appraiser in the world and for MH and RV. And so we couldn't get anything done at CBRE. So then, Bruce was like, why don't you come over here? And so, and there was some things going on at CBRE, some changes that were going on that, maybe weren't as appealing to me. And so, I went with Bruce to CBRE, started the group there, and he had been already doing the appraisal work. And so I started the brokerage platform and the debt platform. And I've been at Colliers for maybe 7 years or 8 years and built a great team here and some of the best guys in the industry. Richard Knapp on my team from Carlyle and Blackstone and Wharton grad, super smart, one of the best underwriters in the industry. Michael Barnett, University of Miami grad, works for Richard. And Carrie Pell, a Wells Fargo alumni, and she's great out of Charlotte. So they're scattered around the country. And then I've got some of the most experienced brokers that were also owner operators in the Tampa Bay area. Bill Haldane, who's him and his brother have had a big portfolio and throughout the years, and so it's invaluable to have someone with that experience because you've got they've done all the work, they've done all the things that you do every day, and they've the good and the bad. And so when you're advising a client, having that experience, it's not just a spreadsheet, it's a lot more than that.
Yeah.
And so I think that having the people on my team that have operational and some more depth, I think is super important as an advisor. So, and then we've got a marketing team headed by Ashley out of Austin, Texas, and Chris Clay, who's been with me for many years, he does debt, and he's also been one of the leading brokers. And so he was with me at CBRE and came over to Colliers as well. So, we just have a very strong team. And Kristen Nissley, my daughter, does public relations for us. David Nissley does brokerage and marketing. And so, but we've got teams. Colliers has like the top team in the UK that specializes in mobile and RV. So in Australia, we used to have the top team, and they got recruited by one of the big operators in Australia. So we still have people that work there, but they're being gobbled up by some of the operators.
I
And
don't
we,
hear much about that, right? The
Mm,
global
yeah,
MH platform, that there are
exactly.
caravan parks and mobile home trailer parks in other countries. That's interesting. How much do you have your hands on, in that business?
Well, it's very interesting. So when my family started, we couldn't get a loan for a park. None of the banks were really liking that type of loan. So the first 10 deals we bought, seller financing, right? And so like there's a long path since then that's institutionalized the asset class, MH in particular, and RV is moving in that direction as well. But now you got Fannie, Freddie, and all the banks and insurance companies, and so it's a very well understood asset class, stable, one of the best, and it's performed the best, probably over a long period of any other. So, so anyway, it's evolved, and so the global asset class has always been there, but it's always been locally owned, and it really hasn't left its neighborhood as far as cross-border investment. There hasn't been very much, but in the last probably 10 years or less, it's really accelerated. And so you've got US people investing in Australia and UK and broader Europe and Canada, and then you've got Canadians in the US. There's a lot of Canadian pension funds that are funding US MHC. You've got UK investing in the US. I mean, and you've got private equity that sort of has their fingers in all of it globally. And so it's just and pension funds they like the asset class because it's a safe asset class. It sort of follows the demographic bubble of senior and affordable. And so those are the two, great bubbles to invest in. And so I think they're smart long-term investors. And so they've identified this asset class as one of the best. So
And I know, excuse me real quick. I know you work a lot with institutional
Mhm.
investors, right? The pension funds and other big REITs and so forth.
Yeah.
So how would you say they look at the asset class different than, maybe some other mom and pops or, more smaller operators like myself, right? We
Yeah.
own, quite a few communities, but 3,000 lots, but we're small potatoes compared to ELS and some of these other big operators, right?
I think all of them started humble the same way you did. All of them, Sam Zell, all of them. But as they evolved, they started buying larger and having more economies of scale and refining the quality. So I think it's a normal evolution. When you start off in anything, your entry point might be, the subpar, 2-star parks, and that's where you enter. You get the highest yield, and then as you harvest your profits, you step up and get the nicer assets and that are more passive, and as you don't want to work as hard and you don't want to struggle through so much capex and park owned units and all the things you got to do at the beginning, and and so then you evolve into more passive. But I think those guys are already there. Money is less of a constraint. The individuals are always looking to get good financing. RVs probably more of a challenge than MH, but I think it's still when they've got the lowest cost of capital and sort of unlimited capital, I think they have a big advantage and they think about their investments differently.
And maybe you
And
can touch a little bit on that. Like, what features of a mobile home park itself make it institutional quality?
I mean, the typical things that people, have said over the years have been 200 plus sites, public water and sewer, and good MSAs, and those type of things. But I think as the supply, you know, gets gobbled up and more institutionalized and consolidated, I think the larger owner operators are willing to sort of buy smaller and maybe more tertiary than they were, just because it's supply constrained. We're not building enough parks to keep up with the demand. And so therefore, if you want to keep buying in the asset class, you probably got to buy smaller. And there's been, we had some recent trades where the average deal size within the portfolio was maybe 50 to 75, but 2,000 lots and all clustered where they operate efficiently. It's sort of, you're buying zip codes rather than worrying about how many units are in the park. So So I think that's a different way of doing it, but it's also addressing maybe the difficulty to compete with some of the institutional investors. So I think
Definitely.
economies of scale can be achieved in other ways.
Definitely. And then
Yeah.
let's talk more, about the sales side, right? And like,
Mhm.
what would you say are like the essential steps that you take in evaluating a mobile home park? You and your underwriting team, from your
Okay.
time in the space, what specifically do you look at to determine value and what matters most? Obviously besides the income that it's generating.
Yeah. So generally, we're representing sellers majority of the time, and so sort of our mission has been to help the mom and pop sellers with, when we're even institutionals as well, but or family office or some, but they need help, and they're oftentimes they're really good at managing, operating the day to day, but they may not be in the selling business. So it's like a different business than operating a park, right? So when you're buying, it's one game, and when you're operating, it's another game. When you're selling, it's another game. So we understand the selling game really well, and so what we try to do is help them, because I think that they're often at a disadvantage, and they're not maybe underrepresented, and so we're trying to make sure that they get a fair deal. There's been a bunch of stories where people you know you know didn't get a fair deal, and it's their one shot in life to cash out, and so it's a sad story when you hear about that, and they weren't represented, or they wanted to avoid paying a commission, but they lost 5 million instead of paying 200,000 in commission. So I think it's a good deed to help the sellers with that process, and to make sure that it's truly a market deal, and that's what we try to accomplish. And so just starting off with the very basics, and depending on the sellers and their level of sophistication, there's some basic things, right? Sometimes they've got things in their expenses that are capex, or just things that don't belong there, that are understating the NOI, because their financials they provide us are for the purpose of minimizing taxes, not for
Mhm.
selling. And so we often have to help them with with those basics. And then but then you'd be surprised, the larger guys are also, you know, for whatever reason, they're so big, and so, they're just machines, and maybe they're leaving something on the table as well. And so, you know, we recently, we have a very large transaction that's closing in the fourth quarter, and $750 million, and a big institutional owner that had some major things that we identified that were just, and it wasn't really on the financial side, but it was on the operational side, and it was not like heavy lift operational. It was just like stuff that they weren't doing, and they're sort of in a different business. It's not their primary business. So we helped them, and we created significant value by just we identified 6 or 7 of the major upside pieces there that allowed them to articulate, or allowed us to articulate what the opportunity really was, and it wasn't just the NOI.
Because
So
that's the piece, right? Is like telling the story, right? It's not just the
yeah,
NOI. It's, hey, this is a large buyer. This is not their main competency. They got in
mhm,
here, and maybe their management expenses are, double the average, management expense, right?
right,
Because they don't have a
right,
big enough portfolio to have the scale they need to have enough people, so they have higher management fees. And then you come in and say, hey, when you're selling that to a new buyer, you say, hey, this is really supposed to be about,
exactly.
3 to 4% of gross, not, 10% of gross. Is that the kind of stuff you're talking
Yeah,
about?
I mean, we go through every line item, and there's, you know, and not everything falls within a certain range, because different properties operate differently, and they've got different characteristics. But, we sort of have a good feel of where payroll should be, and we have a good feel. So one of the things that we run into with some of the mom and pop operators, and maybe in particular in the RV space, we may have, a family that's all been working for a long time there, and may have like a payroll that's off the chart, $1 million payroll. And, it probably needs to be 2/3 or a third of that, right? 2/3 should be cut off. And so sometimes we have to like almost argue with them on why we need to present it in the proper way because they're just running way heavy. And they're like, I don't know if you can do that. But eventually they understand because the day after closing, the buyer is going to cut all of that. And so they're basically gifting the buyer a lot of money. So we try to within reason, we're not, trying to overprice things, but we want to make sure it's a fair deal and that everything's being looked at. And so we take that job of representing our sellers seriously. And some of the people listening are like buyers and they're like, oh my gosh, but someday they'll be sellers and then, they'll probably want to talk to me because I'm not just introducing you to my friend, I'm running a full process. And so not only do we get to the value and underwrite it properly, and we also expose it to a huge, audience and to make sure there's, plenty of the market participants making offers and there's a
Sure.
competitive process.
What talk about park-owned homes?
Hmm.
Do institutional buyers add value to those? How are they valuing them? I know, like, I think it's UMH
Hmm.
or RH. No, I think it's UMH. They have like a large, straight rental communities. I went to one of them that was like the community of the year in Memphis,
Hmm.
Memphis Blues, I think it's called, and it was
Hmm.
beautiful. They like scrapped the whole park from what it was and just brought in all new homes, all new roads, all new everything, and they're
Yep.
all straight rentals. Maybe you can talk about that for a minute. Just how they
Yeah.
look at park-owned homes and kind of maybe how your opinion on park-owned homes has
Yeah.
changed or hasn't.
Yeah. When we started, we had a very high percentage of park-owned units, my family. And as over time, we became more passive and sold them to the residents and just tried to stick to mostly lot rent. And I think that most people evolve to that. There are some operators that do a great job at park-owned units, but it's a hands-on business. It's more like an apartment, and but the revenue is very attractive if you can manage the expense side, capex and turnover, then I think it's a good business, but you got to work for it. So, but I think that some people do it very well. I would say majority of the people are looking at park-owned units, and the goal is to sell them off at some point.
Yeah. Yeah. And that's probably for the financing benefits, right? Agency, they
Yeah.
want to see you with a lower percentage of park owned homes and they'll give you
Mhm.
better terms, accordingly. So
Yeah,
that's
and
good to know.
management intensity, right? I mean, I think
Yeah.
just managing park-owned units is not necessarily easy, and if you don't pay attention for a little while, it can sort of spin out of control quickly. So, and it's
Totally.
capital intensive, and so some of the investors are, they're syndicators, and so going back to their investors and asking for more money because they got behind on park owned units never is popular, and so I think when you don't have those, then you reduce the amount of potential capital call situations.
Totally. Mike, what has been the most challenging mobile home park property that you've ever sold during your career and why?
I mean, there's lots of challenging ones, but hmm. um, I don't know. I mean, there's a lot of them. It's just some of them are overpriced. Some of them have all kinds of dynamics. There's probably some entertaining stories, but I think that I don't want to call out any individual properties. I'll get in trouble somehow.
But maybe is there
But
like, due
yeah,
diligence? Because like, we
yeah,
we wholesale some parks
hmm,
and not many, but like, we have a sales team for our own acquisition funnel. If
yep,
we come across something that doesn't quite meet our criteria for some reason, we'll wholesale it.
yep,
And I would say, and we also wholesaled some self-storage stuff. I
hmm,
would say the self-storage stuff, we sell probably 9 out of 10 deals that we send out. The mobile
hmm,
home parks, we'll get 9 out of 10 under contract to sell them, but
hmm,
then half of them fall out in due diligence because you're talking about 50-plus-year-old utility infrastructure, and if you want
hmm,
to find something, you can find something to
yes,
get scared of. So I, I
hmm,
I'm sure as a broker, there's a
yep,
little more variability there, right? To like the deals that get done.
100%. I mean, I don't know a lot about the assignment business, but I could imagine that the level of due diligence that you do on assignment versus something you're going all the way to the finish line with will probably be a little less. So then probably the risk on that transaction would be a little bit higher for you guys and for the buyer, because they don't fully know what they've got. They've got to do a full due diligence. So, right. So I think that's probably with a self-storage, there's probably less variables to be concerned with. And so I can see that. I think, during the last, 3 years since rates have gone, and we've seen this happen in other times. In 2008, there's, the economy and rates and banks. I think that sort of makes the overall business hard. I don't know, individual properties, there's a million stories of sewer and, somebody hiding money or just all that kind of stuff. And we've seen all that through the years. But I do think that in this current market, just the disconnect between the buyer and seller and value, just because of rates, it just made, everything come to a halt for a while. And I think now we're starting to see a little bit of movement in the right direction. At least Canada's lowered the rates 2 or 3 times, and looks like US is ready to do it sometime soon, or after the election, sometime soon. But anyway, people are a little bit more optimistic now, and I think people are starting to transact more, and pricing is maybe getting closer. Buyer and seller are getting closer to consensus.
Maybe. Yeah. Spoken like a true broker. We're maybe getting closer, right?
Well, no, there's more. There's more that are
they're transacting
now.
Yeah. Sellers are realizing, hey, we got to do something if we want to get this thing sold, right? Mike, what do you think is the toughest hurdle that like people need to overcome when it comes to mobile home park investing? Like the normal operator, what's the toughest hurdle that they have to, like, if it's a newbie and they're going out to buy their first park, what's the biggest hurdles that they're stepping into that they might not be aware of?
I mean, I just think some of the people that we worked with started off maybe too aggressively buying something that was a really big, heavy lift, and they got themselves, way over their skis early on, and it sort of hurt their momentum. And I know some other guys that sort of bought some basic deals that not too crazy, and then built slowly, and then, got comfortable with more value add, or, could take on some things along the way. So I think getting off to that good start, I think, is helpful, because then you build confidence in your capital, and your capital wants to give you more, and then it works. But if you have a couple difficult ones at the beginning, then raising money gets harder. And so I think that I've seen, a lot of people through the years start up, and, and I think most of the wise ones are just trying to get like a vanilla deal to start with, and just get the ball rolling, build a team where you have excellence on your team, and accounting and reporting and operations. And because initially, probably when you started, you had to do it all yourself, right?
Totally. Yeah. No, I think that's great advice, Mike. It's like Frank Rolfe says at his boot camps. He's like, hey, for your first park, just buy a park with, city water and city sewer.
Exactly.
Don't go buy a lagoon your first park. Don't go buy a wastewater treatment plant your first park. Go for a solid base hit, and then, you can build up some momentum. I think that's like some of the best advice on this podcast, because I've seen it time and time again, like you said, where people go in, they bite off this huge infill project because the numbers look really good on the spreadsheet, right? If you can fill every lot for 25 grand and lot rents are 500 a month, it looks really great. But if you run out of money, or like a park we just looked at, 125 lots, 82 occupied, went and looked at it, looked good from afar. You get on site, all of the concrete pads have like erosion underneath of them. So the community's not allowing any homes to go in on all these vacant pads, because like they're eroding, like the pads have cracks in them. They're about to, because it was built, the foundation wasn't set properly. So, I think that kind of carries into my next question, due diligence and the importance of that. And, what would you say are like some key things that people need to look at in due diligence right away?
Yeah, I just think, the obvious things are park-owned units, and sometimes it doesn't show up as park-owned units. Sometimes it shows up as notes or or it shows up as a private owner that owns, 10, 20, 50 homes, within the community, or it's titled and it's somehow related to the owner. So those things are always, you want to understand those and the complications that come with, getting the title and getting control of your community if you're going to buy it. Water, sewer, roads, electric, right? Park owned unit CapEx, right? Those are all the big CapEx items. So making sure all those things are not not ignored or missed. That we
Yeah.
A couple times when my family was buying early on, there was a sewer permit on a private sewer that was coming up, and we didn't really give it weight on how that was important and what the ripple effect could be. So sewer permit came and the DEP came and they said, oh, you've got to upgrade your retention ponds. That costs a lot of unknown capex, unexpected capex, and then the ponds were not percolating. So then we were in trouble there too. So I think that just besides you got to know the condition of the plant, you got to know what the regulatory bodies may ask you to do when that permit comes up, because I think that's something. If it's 2 years away, you still got to look at it, because even though you don't have to spend money day one, in year two, you may need to spend that money. And there's, certain areas are getting more strict on and water and sewer plants, and they keep on requiring a higher level of capex. So I think those things, and I think some people don't really appreciate the electrical side too, because there's always, people have rigged some of their things, and if you don't really hire a professional, you may not see it. And so we have people that are, the electric's shared between multiple units, and the breakers are always going off, and it's like probably a safety hazard for fires and stuff. So I think that's always, so I think that people should not try to save money and go cheap on capex, because it'll cost you later.
Cost you in the long run.
Yeah, for sure. For sure.
That's good. What mistakes have you made, Mike, in mobile home park investing that we could learn from?
Sewer, that sewer situation. Trying to think of what else. I think just early on, I think on the spreadsheet, the park on units just looked very enticing. So I think that it looked good, but when you had to actually do the work and really, stay on it, I think it was more difficult than anyone anticipated. And yeah, so I don't want to elaborate too much on that. There's some very
Sure.
colorful examples that Frank Rolfe usually tells in his seminars. But but park on unit just adds a lot of management intensity and the capex
Yeah.
required, and getting the capex done in a timely fashion so you can get it rented again it's just a lot more involvement than
Yeah.
should be necessary.
And like you were talking about earlier, at scale, right? That
Mhm.
only compounds the issue, right? And a lot of
100%.
people, I've said this before, but a lot of people don't realize that, manufactured homes, the windows are different sizes, the doors are different sizes, the drywall is a different size. You can't just
Yep.
go to Home Depot and get this stuff. You have to
Nah.
special order it if you want to do it the right way. And so
Yep.
that adds a layer of complexity to renovating these units and the costs involved. So
Yeah.
good insight there, Mike. Going to go into a little lightning round here. Just,
Okay. Yeah.
4 quick questions, and you just fire off what comes to your mind first. All right.
Sure.
If you were going to invest passively as a limited partner into a mobile home park deal, what are the things you would look at in the deal?
Passively LP, I would look for large, high quality in a growing market. So, in some of the, high population and job growth markets, if it's MH. If it's RV, it may be more, a little different, more destination oriented. But, Texas, Florida, Southeast, all these fast growing states where everybody's moving for jobs and for climate. I think those are, the winds at your back. And so you can make mistakes, and it's more forgiving. If you're in some of the other states with the population growth and, job growth and rent growth is lower. So all those things are harder to cover up mistakes. So it's good to, so I like those places. And so if I'm an LP investor, then whoever the GP is and the operator, I'd probably less likely they're going to make a mistake and my money will be safe.
Yeah. No, it's always nice to have the wind at your back. That's for
Yeah.
sure. And I started out in tertiary,
Mhm.
Midwestern markets,
Mhm.
did well, the value
Yeah.
add kind of hustle. But
Yep.
as we mature in our kind of buying criteria, we're looking at better markets, higher median home prices. And it's just it's nice to have that, maybe a little bit more rent growth than you planned on is always nice. So that's good. Sorry, go
I
ahead.
think as you get older, you want to be more passive. I think that's everybody in the industry that I know is kind of in that direction, just because it's a lot of work. It's a lot of work when you have the less passive investments and tertiary. You got to hustle, and I think that as you get older, you probably established and created some wealth and success, and so it's time to sort of change the profile.
Yeah, have more reliable, less turnover, that kind of stuff
Mhm.
matters
Yeah,
quite a bit for sure.
yeah.
Mike, what do you think the perfect mobile home park looks like in your eyes and why?
Wow. I think that, senior parks in places like Arizona and Florida
Mm,
you've got a lot of wealth in those two areas that are coming from, the New York or the Northeast wealth, and you've got California and, West Coast wealth going to Arizona, and some Canadian wealth going to Arizona. So I think those two states are sort of probably the gold standard in investing. I think there's lots of other good states, but those two have traditionally been highly desired by all the institutional guys for those reasons, because disposable income and high housing prices and that type of thing always
yeah,
work in your favor.
that's huge. Yeah, my wife's aunt lives in an all double wide community in Huntington Beach
Yeah,
and in
crazy.
California. And
Yeah,
literally, she said, "We don't want to live anywhere else.
yeah,
The place is immaculate. It has
yeah,
like a pool, it has all of that, and they're walking distance to like the downtown strip where all the
right.
restaurants and the
Yep,
pier is, and it's like that is such a high quality
yeah,
life, right? Your lifestyle is just so great, and
exactly.
it's a different, a different type of park, right? Than what people
That's
assume when they think of mobile home park or trailer park. They don't even know, like there's such high quality assets out there like that in great locations.
and
So
if there's not rent control that's sort of changing the profile of the investment, but you just have the gap between the cost and the affordability issues, just such a positive thing in some of those high rent, high sales markets that as long as rent control is not too restricting, I think it's great. Even, California has some great parks, and you just learn how to play that game, I think.
yeah,
And those owners have learned how to do it. And some of the people from the East are like, I'd never invest in California, but the people that own there, they love it.
they love it. Yeah, they still
Yeah,
transact at pretty
exactly.
pennies because of
Yeah,
if you know how to play the game. Because I think it's something like if you invest a certain amount of capex, then you can go above the expectation,
exactly.
and so there's definitely a good game there. Mike, what do you think the biggest threat to mobile home park investing is?
Yeah, so I think, rent control, I think, regulation, rent control hurts it. I think that most of the time when they put these things in place, there's just like every regulation, there's always loopholes and there's always the smart guys who figure it out. But I think it puts a little bit of a damper on it. If everything was rent control in the US, it wouldn't be as attractive as it is. But
Hmm.
I do think one of the other things is, you know, there's not enough development going on right now. So I think that the aging of the existing communities is, you've got a lot of them were built in the 70s and 80s, and they're, past their useful life. So, and we're not rebuilding enough to replace them. And as the urban core keeps growing out and out, we need to build in those, right on the edge of the urban core. And that's kind of, you know, we need more development. And I think financing for development, I think there's been little booms through the years, but nothing like it was back then. So I think that efficient financing for construction and for the homes themselves will pave the way. So I think if we had Fannie Freddie that was financing the homes, then that would be a game changer.
Huge. Yeah. I talked to
Yeah.
one mom and pop, and they said that they were able to build their park back in like the 50s or 60s they were to build it with a government loan. I don't know if it was HUD or agency. They were able to build their park with 3% down. So
Yeah, yeah.
97% loan from the government to build the mobile home park.
Yep.
And they built it out in phases. So we need something like that to get more
Yeah,
of
yeah.
this happening. But I think the zoning restrictions are just super prohibitive right now. So
I mean, zoning in any of the urban centers they're gonna say no. So then that means you're gonna be pushed out into outside the urban service boundaries, which means private utilities,
yeah,
right? So that's the new growth will have probably private utilities. If you don't have the zoning problems there, you'll have the utility problems. But I think there still needs to be, and so I think that's the threat. If it's too difficult to develop, then I think the industry, there's not enough supply, and there's so many people getting into this great asset class that they may go look elsewhere
yeah,
because storage, they have more construction. Even RV probably has more construction than MH,
yeah,
and all the other asset classes. They're adding supply to hotels and apartments, and maybe not office buildings right now, but traditionally through the years, all the other asset classes have had you know supply. They've been steady supply of new product. I think it's a good thing for our industry to have constricted supply because that ensures that if you own something, you're in good shape and not going to build next door and
sure,
dilute you. But I do think if we don't build more, it'll cause a problem eventually.
yeah. I heard this threat yesterday from a friend of mine, and I'm curious your thoughts on it because you've been through multiple cycles, 2008, right? Like all of
Yeah.
that. But he said, artificial intelligence, he fears is going to
Hmm.
uh, displace a lot of the low income workers,
Hmm.
factory manufacturing jobs.
Yeah.
And over the next 15
Possible.
years,
Hmm.
they will have trouble finding, more consistent employment potentially. And
Yeah.
he worries that that could hinder the asset class's ability to, consistently, keep up with, you know, keep up with
Everything.
their
Yeah.
occupancy and everything. So what are your
Interesting.
thoughts?
Man, that's above my pay grade, but I do think that, some of those demographic shifts are going to have an impact on all housing. And then the fact that we're providing the lowest cost housing is probably a good place to be no matter what happens because
Sure.
the guy that's in a $500,000 house may downgrade to a manufactured home because his circumstances change. So we're probably in the safest place.
Yeah. Well, dude, thank you so much for coming on,
Yeah.
Mike. This has been
Yeah.
fantastic. If any of our listeners would like to get a hold of you, Mike, or check out the Colliers platform,
Yeah.
for MH and RV, what's the best way for them to get a hold of you?
Okay, somebody told me a generic one, but I'll just give you mine because I don't remember the other ones. So mike.nissley@colliers.com. And my phone number is 561-479-1588.
Awesome. And we'll put that in the show notes. And you're based out of Boca,
Boca
correct?
Raton, Florida. Yes.
Awesome. Fantastic.
And we cover
Uh,
the whole country. We cover North America. I've got team members all around the country.
that's fantastic. One last question. What's one last bit of important advice you would give an interested passive mobile home park investor before we sign off?
Wow. Make sure you have a good operator that you partner with, right? If you're equity that's looking to invest, rather than do it yourself, partner up with someone early on to avoid those missteps and, keep your money safe. And then later on, if you feel more confident, then you can go off on your own. But I think you need a good operator to partner with. I think that'll ensure that your first experience is more positive.
That's great, Mike. Well, thanks again for coming on the show. That's it for today, folks. Reminder, if you got any value out of this show, which there was a lot of golden nuggets, if you got any value, please leave the show a review. That helps us, get more views and lets me know you're listening. So thank you all so much for tuning in.
Thank you very much.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.